Thank you very much, Joanna, for that kind introduction. Indeed, we tend to make European regulations not very attractive with these horrible acronyms, indeed, including MiFID, and we make the documents very thick. So maybe we can improve in that respect. Ladies and gentlemen, 2 Dutchmen in Scotland sounds like the start of a good joke. But we're here today to discuss serious business. How can capital markets perform well to the benefit of investors, including pension funds? Let me first say that I'm very pleased to share this panel with Chairman Hans Hogevorst. We've worked together at the AFM, the Dutch Authority, the Dutch Securities Markets Authority, and later on we're working together now in our roles as chairs of ISB and ESMA. The European economy is on the verge of gaining strength, but we cannot exclude a possible deterioration. All possible efforts need to be done to get the economy back on track and in the right direction. The ECB, the European Central Bank, embarked earlier this week on its public sector purchase program. However, monetary policies alone will not be sufficient, and we need to complement that with structural reforms. And increasing the role and the performance of capital markets should be part of these structural reforms. The European Commission's initiative to establish a capital market union, or a CMU, builds further on the European Union's long-standing tradition of integrating the capital markets of its 28 member states. We more than ever need to develop alternative funding channels to ensure maximizing the benefits of capital markets and non-banking institutions for the real economy. Pension funds, with their long-term focus and willingness to take calculated risks, are ideally placed to actively participate in this development. Europe is still relying dominantly on bank financing, and there are still too many barriers within the internal market. Although one could argue that for the large so-called blue chip companies, we have created a CMU, a capital markets union, an investor wanting to invest in a mid-sized company still has a strong bias towards companies in his own country. This means that because of this bias, transactions are not happening that would be beneficial for both the investor and for the company. What is needed to achieve a strong and integrated EU capital market to increase capital availability and support economic growth? With a 5-year time horizon in mind, choices will need to be made. In my view, there are 4 main building blocks of a capital market union, which are all interlinked, and on all of them we need to progress. First of all, greater diversity in funding. Secondly, increasing the efficiency of capital markets. Thirdly, strengthening and harmonization of supervision. And fourthly, increasing the attractiveness of capital markets to EU investors. That is all about investor protection, but I will explain that later on. In my contribution, I will explain all 4 building blocks. However, as I would like to go into greater detail on how to increase the efficiency of capital markets and increasing the attractiveness of capital markets for investors, let me first go into the need for greater diversity in funding and the strengthening of the harmonization of supervision. Let me start with the first building block, the greater diversity in funding. This implies a shift in the balance from bank funding to non-bank funding, but also developing and maintaining a wide variety of funding channels within the non-banking sector, including investment funds, initial public offerings, venture capital, securitizations, private equity, and crowdfunding. And regarding this latter channel, I should mention that in January, ESMA has given advice to the European institutions on crowdfunding. The advice balanced the opportunities for crowdfunding platforms to develop their business with ensuring adequate protection of investors. This balance is absolutely needed, as it is naive to assume that risks of investing via these platforms would be lower than traditional investing. More funding channels will increase choice and competition in our financial system. And I think it's up to investors and market participants to decide which channel best suits their investment and funding needs. Policymakers and regulators should be careful to assume the superiority of one channel over the other. On the building block regarding supervision, Europe has the most to benefit from open markets and should avoid fragmentation along national lines. To ensure the success of the CMU, we need to avoid regulatory arbitrage. Converse supervision, by which I mean consistent application of the same rules and using similar approaches, supervisory approaches, across the 28 EU member states, is and will be a continuous effort over the coming years. It is needed to ensure that the single rulebook on paper becomes the single market in practice. Given the breadth and complexity of the single rulebook, regulators need to make many choices regarding their supervision, including the interpretation of the rules and determining the intensity of supervision. Diversity in these choices will have the result that the single rulebook will not in fact be seen as such by investors and market participants. This is not an academic debate or a power game between regulators. It is about practical implications for market participants and investors. Any retail investor or company that has been active in different countries will, without doubt, underline the importance of applying, supervising, and enforcing basic technical rules consistently. Regarding the third building block, increasing the efficiency of EU capital markets, policies are needed to increase capital market financing with deep, liquid, and well-functioning markets in the EU. This is affected by many factors, including disclosure requirements, accounting standards, corporate governance, transparency around pricing of financial instruments, and the legal arrangements regarding the various stages of a financial instrument's life cycle. Deepening European capital markets is at the heart of ESMA's activities by, for example, developing technical standards for securities markets that directly apply across the EU. In the past years, we have made many contributions to the single rulebook for capital markets in response to the financial crisis. While many of these new rules were implemented with a strong focus on financial stability, which is of course very understandable considering the financial crisis, in reality, they have been as important for further integrating EU markets. Let me provide one example, and it concerns derivatives, which are very relevant for pension funds. We have created already something that one could call a derivatives union. I know it's a very popular term, but indeed, we have moved to a derivatives union with a high level of consistency and coordination across the EU, both regarding regulation and supervision. The two main elements of this development are moving to central clearing of OTC derivatives and reporting all transactions to trade repositories. This will make this market more safe and more transparent. Since starting the authorization of all European CCP, central counterparties, under the new requirements of EMIR in 2013, Europe has progressed a lot towards the implementation of the clearing obligation of OTC derivatives. Today, there are 20 CCPs that have applied for authorization under these new requirements of EMIR. 18 colleges composed of the relevant regulators, including ESMA, have been established, and 16 CCPs have been authorized. And you cannot be active within the European environment without these new requirements regarding central clearing and reporting. Following the authorization of these CCPs, ESMA started to analyze the OTC derivatives contracts belonging to different asset classes to determine whether they meet the relevant criteria to go for central clearing. As a priority, ESMA conducted an analysis of the liquidity of interest rate swaps, which account for more than 80% of the global market for OTC derivatives, and they're frequently used by pension funds, as you know. Following a public consultation, ESMA sent a proposal to the European Commission on the 1st of October 2014, last year, to establish the clearing obligation for interest rate swaps denominated in euro, pound sterling, US dollars, and Japanese yen. These proposed rules should be endorsed by the European Commission shortly, and they will be done under the scrutiny of the Council of the EU and the European Parliament, and I would hope that before the end of the year they start to apply the central clearing obligation. This upcoming central clearing obligation should result in a significant risk reduction of systemic risk in Europe. And despite this overall positive development, I'm fully aware that pension funds have always been worried by the impact that a clearing obligation might have on them. And in that context, and probably as you are aware, The European Commission has recently extended the deadline for the temporary exemption for pension funds from the clearing obligation for another 2 years until August 2017. The temporary exemption will not apply automatically for all pension schemes, and for some of them, the national regulator shall grant exemption following an opinion of ESMA after having consulted with our colleagues of EIOPA, as mentioned by Joanna. ESMA is already working together with EIOPA to ensure the smoothest possible process once the national regulators will start receiving the requests for exemption, which will be after the entry into force of the clearing obligation. Another relevant requirement of EMIR that will affect pension funds is the requirement to exchange bilateral margins when entering into OTC derivatives transactions that are not centrally cleared. On this issue, we, together with EBA and EIOPA, are expected to issue a second consultation paper in a few weeks. And I can assure you that the implementation calendar will be fully aligned with the international one, and including the minimum €8 billion threshold below which no initial margins should be exchanged. Let me now go back to the topic of the CMU, the Capital Market Union, and increasing the efficiency of capital markets. Despite the good progress I've just illustrated with derivatives, there are still many areas where differences in rule hamper the development of a truly integrated EU capital market. One such area is SMEs, small and medium-sized enterprises. Capital market instruments like equity and bonds have remained a costly tool for smaller companies. This is the result of many factors, such as the limited availability of credit information, different insolvency rules across the EU, and the different disclosure requirements, including accounting standards. We cannot remove all barriers for SMEs. We need to focus on those areas where we can expect the biggest impact. And for example, the introduction of IFRS has had a great positive impact on companies listed on regulated markets in the EU. With that in mind, we should consider moving to a common accounting language for SMEs that would like to grow and get a broader investor base. That language should be based on IFRS, but not as extensive as the standard set of IFRS. And that brings me to the last item I would like to discuss with you today, or the fourth building block of the Capital Market Union, increasing the attractiveness of capital markets for investors. A successful capital market requires active participation by investors, including retail investors. The frequently used example of a better balance between bank funding and markets funding is the US. And just to share a statistic with you, participation of households in the US securities markets has strongly increased in the past 30 years from about 45% to about 65% of all households. The Harvard professors Greenwood and Sharstein have convincingly argued that this development played a key role in lowering the cost of capital for listed companies and has especially benefited young entrepreneurial firms. While there are big national differences, participation of EU households in securities markets is typically much lower. To put it bluntly, Europeans like to keep their savings in deposits. However, this preference can be expected to change. Pension systems in the EU are being reformed as a result of rising life expectancy, as we have seen very well in the previous session, low birth rates, and the financial and economic crisis. According to the Council of Europe, 90 European countries have increased the retirement age and 11 decreased the level of pensions in recent reforms. The public share in retirement income in Europe will decrease, on average by 10 percentage points until 2016. Today, roughly half of the retirement income comes from public schemes in EU countries, but this will only be 40% in 2016. And this is just an average. In some countries, this share will be even lower. And since the share of private savings in the mix of retirement income increases, consumers depend more and more on their own financial decisions. With this greater personal responsibility for pension arrangements, more active participation in the capital market can be expected. But of course, this greater participation needs to go hand in hand with better investor protection. Only when investors feel sufficiently protected will they be willing to enter in the capital markets and participate. As trust in the financial sector is generally low, a lot of work remains to be done here. While this has gradually been improving in 2013, still only 35% of EU retail investors trusted investment services providers to respect consumer protection rules. To improve investor protection, MiFID II is probably the most important area on which we have worked in the past year. It provides a framework supporting investment firms to act in the best interest of their clients by improving governance and organizational requirements for investment firms, by strengthening conduct of business rules regulating the relationship with all categories of clients, and by introducing new powers to supervisors at national and EU level. Over the last few months, the proposed measures in relation to a particular potential conflict of interest, those on inducements, have proven to be very sensitive. Allow me to touch shortly upon this particular item, because I know that it might come back during the questions later on. The framework for non-monetary benefits, and particularly the treatment of research. MiFID II strengthened the requirements on inducements by introducing a stricter regime for portfolio managers and providers of independent advice. This regime goes as far as prohibiting firms to accept and retain monetary or non-monetary benefits paid or provided by third parties. The only exception to this rule concerns minor non-monetary benefits, which, besides being capable of enhancing the quality of service provided to a client, are of a scale and nature that they do not impair the compliance with the firm's duty to act in the interest of the client. As you may know, the Commission asked ESMA to provide advice on potential implementing measures on MiFID II, and we published our consultation paper in May last year. That was the thick document that was talked about. We set out several topics in this document, and investment research was extensively discussed. But the focus was not in research in general, but on the mechanism commonly used by the industry, which enables portfolio managers to receive research from executing brokers out of dealing commissions. In the investor protection area, the treatment of inducements was the topic that received most of the feedback from stakeholders. And we're pleased that the NAPF broadly supported ESMA's proposals in these areas. ESMA has carefully reviewed the feedback received from stakeholders and has delivered its final advice to the Commission in December. And in our advice, we have modified the initial proposal in order to specify and detail the conditions under which the receipt of research should not qualify as an inducement under MiFID II. On the basis of ESMA's proposal, portfolio managers should be allowed to receive research from third parties and to charge clients for that research. Therefore, the proposed regime does not oblige firms to pay for research out of their own resources, but it allows firms to pay for it from a separate research payment account controlled by the investment firm and funded by a specific charge to the clients. However, in this context, ESMA's advice suggests that firms should budget costs for research on an ex-ante basis, should obtain clients' approval for this, and assess the cost and monitor the quality of research received and its effective ability to contribute to better investment decisions. A written policy provided to clients should document the approach of firms to research. The proposal, in line with legislative objectives, breaks the link between payments for research and for execution. It enables firms to choose different models to access research, and it should lead to better informed investors and to a more competitive and transparent market for research. Concerning the possible impact on SMEs, no evidence has emerged that the current system ensures a better coverage of SMEs and better quality of research provided, or that these objectives should be pursued through a combination of the bundling of the dealing and research commissions. Ladies and gentlemen, it is time to conclude. The CMU is an ambitious initiative. Action needs to be taken to build this much-needed union, which is an appropriate response to build a strong, safe, and integrated EU capital market, which will help the EU economy to flourish again. The end goal should be a CMU based on an accelerated integration of the capital markets of all 28 EU member states. The CMU should be competitive, efficient, and provide a wide range of funding channels, and the protection of investors should play a major role in building it, because the CMU will only be successful if it is and remains trusted by investors. Thank you very much.